means and what's important about it. There is many things important about the volume discussion. We're going to start off first about what people usually are looking for when they use volume as some sort of an indication. The idea is this: what you're trying to do is understand if the price is going up, is it because of retail traders, the so-called dumb money, you and me, or is this the smart money, the big bucks, somebody with inside knowledge that's buying and that's why it's going up? We'd love to know what the smart money is doing. And that's where we would like to be buyers, following those as tips. And so the idea is, well, smart money has a lot of money. And so we're going to be able to see how many shares they're buying. And so if they're buying, we're going to go ahead and take action. We're going to be able to make some difference. But there's a few flaws in that theory, and we're going to poke at that over the course of this session. It has become ever more muddy over the course of the last 20 and 30 years. But I'm going to focus on what if we were living 50 years ago or 100 years ago, and we thought that maybe that was our goal. You're living post Great Depression. Certainly market manipulation is in the cards. That's why, folks, the financial industry is heavily regulated now because, well, frankly, in the past, it wasn't, and people took advantage of it. But now it is. But let's pretend that we're looking at a situation where you could go ahead and identify a big spike in volume means somebody is out there buying. Well, let's first talk about what volume is. Volume is the completed share transaction. When we see that, for example, Apple, that we've got here a chart for, has traded 24 million shares today, please recognize that there was both a buyer and a huge spike of volume. That doesn't necessarily tell us that there was a smart money buyer. In fact, it could have been a smart money seller, couldn't it? All we know is that there was a large transaction, or many large transactions, or many small transactions adding up to a large total number. Now, we could find out the size of each individual transaction, but you can imagine at 24 million, and you can see how frequently this number is changing, it would be difficult to add all of these up. Computers could do that for us. But the point is, there's a lot going on. And in each and every transaction, we don't concretely know if there was a buyer or a seller as the quote unquote informed party, as the one we are trying to tell. Is it the smart money that was the buyer, or was it the smart money that was the seller, or was no smart money involved in the first place? It's muddy water in the starting point. That's if we were talking about 100 years ago when there wasn't other things to think about. But let me just pull up for us one reason why this water has gotten extra muddy over the course of recent days. Let's go ahead and take a look at one ETF that recently had a rebalance in its overall portfolio. We talked much about this as this was happening a month and a half ago. But as we take a look, here we have the portfolio composition of a fund named XLK, the Technology Select Sector SPDR. If I scroll down just a little bit, we'll see that the top holdings of this fund include 4% in Apple, 20% in NVIDIA, and 21% in Microsoft. Seeing Microsoft at the top of the list, why don't we switch over and take a look at the Microsoft information instead? Microsoft is up right now some $420, and 20% of this fund is also there. Now, you're going to have to imagine with me for just a moment the speed at which a computer can transact. But let's suppose that you see that Microsoft is up 0.95%, but accounting for the 21% that it holds of Microsoft and the 20% of NVIDIA and 5% in Apple and all of the other holdings here on the portfolio value, you notice that this fund, XLK, does not move in the same amount as it should. Today, it's up 2.1%. Let's suppose that based on your calculations, the underlying securities only went up by 2.4%. Or that it went up by 3%. There would be a discrepancy between the value of those two items. You could buy a portfolio matching 20% Microsoft, 20% NVIDIA, 5% Apple, and all of the other pieces, and have this same thing. And in fact, this does happen behind the scenes. This is what's known as arbitrage, folks. And computer algorithms are constantly calculating and verifying that the value here of XLK matches the value over here of Microsoft and all of the others in appropriate ratio. And if one is too high and the other too low, you can bet they're buying the cheap one, selling the expensive. But for those of you who felt like that was a little hard to follow, let's just pretend instead we're not comparing a fund. Let's just compare Microsoft against Microsoft. Let's suppose that we notice that Microsoft right now is a certain price at the New York Stock Exchange over here in the East. And separately on the NASDAQ exchange, it has a different price. There is, by the way, each and every exchange has their own prices at all times. There is also shares of Microsoft trading down here in Australia. There's also shares of Microsoft trading over here in London. There is also shares of Microsoft trading all across the world. At any given time, if this share of Microsoft on the New York Stock Exchange is too high, you would sell that one and buy the shares over here in the NASDAQ or in Australia or in London or wherever it is and take advantage of the difference in prices. Surprising as this may be, and even though the potential profits on trades like this is measured in pennies or less than pennies, this actually makes up a large part of all volume in the markets today. And this is known as high frequency trading. You can imagine that the changes going on across all exchanges and the time to transact across them is a substantial factor in a strategy like this. As a result, it's dominated by very well-funded, high-frequency traders who are co-locating their business right on the exchange so that they can absolutely minimize any potential delay due to just the network traffic moving back and forth. So this is a whole world of volume. And that suddenly points out precisely how muddy the water is. Because if almost all or a large part of the volume occurring in any given security is actually arbitrage-based trading to limit the differences between identical or reproducible assets, then we see that identifying the so-called smart money that wants to buy Apple right now as a long-term investment because they believe that Tim Cook is doing great over there in Cupertino is very different than identifying that the stock went up some or that it went down some or anything else. So there is very, very muddy water. If you hopped into the session hoping to figure out how do we see where the big money is, I'm sorry to say that's just not the case. You are not going to find something. We are still going to tell you all about volume. And now, after perhaps popping a bubble or two out there in the audience, I'm going to tell you why volume is absolutely and unequivocally the most important factor in technical analysis that we see. And that may be a surprise to some of you because you might notice that my chart here does not even include volume. That's because I already am aware that Apple has traded 24 million shares today. I know that there is a very tight difference between the bid and the ask, and I know that at any given time, I am likely to be able to trade my shares of Apple at a fair price, even if I use a market order, because of volume. You might recall that as a technical analyst, the first assumption, the pill you must swallow in order to join this side of the matrix, folks, is that you must assume that the price takes into account all available information. That's a big pill to swallow in some cases. But if you were to look at it in a situation like Apple, where millions of shares and therefore hundreds of millions of dollars are constantly warring back and forth, it's reasonable for us to suppose that the free market has done its job and fair price has been established. Therefore, all known information is being assumed and calculated into the current value of the shares. But volume is what tells us this. If I instead came across a stock that has traded, save one share only today, would it be reasonable for us to assume the same things occur there? Absolutely not. It would be unreasonable for us to make that assumption. Just suppose that your neighbor told you that they sold their house for $10. They could choose to sell their house for $10, but that doesn't change that your house is likely worth a lot more than $10. One trade does not make the fair price. In fact, if that was the only offer, you'd do your best to try and talk your neighbor out of it. Back out of the deal. Find some way to undo this, because that is just not the fair price. It's only when we have a consistent flow of volume of both buyers and sellers that we can rely upon this fair market value idea. So before we step into any additional technical analysis, relying on trend, relying on momentum, relying on any other piece, first we answer that question. And the easiest tool to do so is right here under this volume chart. You just take a look and see, what does the volume look like? I usually translate this for myself into the total number of dollars involved. And if the number of dollars in my personal bank account is larger than the dollars that we're seeing transacted in the security, fine. If the security is going up, but the volume as measured by on balance volume has stopped going up, there's a little bit of concern. We're looking for that discrepancy, telling us that maybe things have changed course. Let's go ahead and take a look at NVIDIA as an example. We could see over here a period where NVIDIA continued to make substantially higher highs in price, but over here in volume, effectively flat or even just a touch negative if we connect these peaks. This does not tell us that the price is going to go down. We didn't know that in advance. What we knew was that volume was not confirming the upwards movement of the price. You might think of it like a warning sign. It's not a red stop sign. It's a yellow warning sign saying, hey, slippery road conditions. We don't know, but we know that there is some additional reasons to be concerned. Just a yellow flag warning us, maybe you should be a little extra aware. If you're trading in NVIDIA and you see a big red bar and we have no volume to substantiate other moves, maybe it's time to pull the plug, even if it was early to pull the plug. But it was reason for caution. This can also happen in a negative way if the price continues to make lower and lower lows, but volume stops going lower and lower. And for this, why don't we jump over to a security that has been moving downwards on a repeated basis, unfortunately. This one is Walgreen Boots Alliance, and we can see that here we had a period where the price was continuing to go down, but not quite as clear of a downwards movement on the on-balance volume. Based upon what you're seeing on the chart, you're asking for that difference. And that term, folks, is a divergence, is what we are looking for. So that's our average volume. That's our on-balance volume, or our two first ones. Now I'm going to step into one that's a cousin of a security that we frequently take a look at. This is it right here. If we go ahead and jump in and take a look, let's swing back over maybe to the NVIDIA chart. And I'm going to go ahead and jump over in my chart to the MFI, or Money Flow Index. Now, this indicator is a cousin to the relative strength index, and you can see index pumping up in both of those names, but also the actual art of these two is fairly similar. We've got a line that ranges from 0 up to 100 on both possibilities. We see that we've got a horizontal line up here towards the top and one at the bottom. By default on MFI, that's set at 80 and 20 versus 70 and 30 on RSI, but it's got some clear similarities. Now, based on the fact that we are including this today, you might be willing to guess that MFI is a volume-focused indicator. But based on its similarities there to our RSI, which is a momentum indicator, you can see that, yes, money flow index also includes some momentum-focused ideas as well. In fact, when we come here and focus in on its list, that money flow index is actually a momentum and volume indicator. Its calculation gets a little bit more nuanced. Instead of just looking at is the price up or down, first you're going to take a calculation known as the typical price. Let's average out the high, the low, and the close and say, all right, based upon that determination, is the typical price today higher or lower than the typical price yesterday? In other words, average yesterday, average today, is that higher or is it lower? And if it's higher, then that's going to be called positive money flow. And we're going to add up all of the positive money flows that exist over the course of the period. The default as set in Active Trader Pro for MFI is 15 periods. So it's going to look past over the last 15 trading periods, in this case days, because my chart is set to daily. And it's going to add up all of the positive money flows. Meanwhile, all of the negative money flows are the times when instead that typical price moves down compared to yesterday. We're then going to do a ratio comparison between the positive days and the negative days and get an overall range here. But since that doesn't nicely measure between 0 and 100, it's then recalculated and turned into what's known as the money flow index, which simply moves it between 0 and 100. If you want the actual math to calculate these, it's readily available on Wikipedia and anywhere else you decide to go ahead and Google it. But having done calculations myself like this in the past, I'll tell you it takes step after step after step after step, and you're going to make mistakes along the way. You got to go back and restart 3 or 4 times. It's just par for the course. But for the money flow index, once we have it all here, and luckily you don't have to calculate it yourself, here we have a tool that tells us about the overall volume. If the price was going down on a consistent basis, then we're going to see this line go down and down and down. If instead it's going up, 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 we're going to see it going upwards. But now it's tempered by the size of volume traded on a given day will also weigh into that calculation. It's not just saying every day that's up is equivalent. Rather, we're trying to weight it based upon the overall size of that trading day. How many dollars traded hands? That changes the scenario just a little bit, but it gives us all of the same possibilities. We're still going to be looking for divergences, and the same one we highlighted before on NVIDIA stands out to us. Flat to even negative line over here on MFI, strongly positive price movement tells us, hey, warning sign showing up here from momentum and volume tied together. But the one thing that the money flow index offers that some of the other volume symbols don't necessarily is this: the opportunity to get a clear signal to buy or sell based upon something occurring. The buy signal comes when the purple line here drops below the red, comes all the way down here below 20 at the default setting, and then comes back above. This hasn't happened in the last 6 months. If I back it up over the course of the last year, for NVIDIA, there hasn't been a single one. If I back it up even further, 2 years, all right, now we're seeing one, but we would have been all the way back here at the start of January before we saw a quote-unquote buying signal for NVIDIA based upon MFI. Meanwhile, a selling signal would be if the price comes all the way up here to the upper area and then comes back out. This is our selling signal. And we have received during that course of time several instances where it got above and then came back below, including fairly recently right at the start of that last run up. Now, looking at the NVIDIA chart in hindsight, I don't want to take this sell signal or this one or this one or this one. We're trading near all-time highs. This technical indicator, along with all others, does not know the future. It's simply giving you a signal based upon the recent past. As we look at this specifically for NVIDIA, we're looking at a change here that there was a adjustment in its momentum. I like to think of momentum indicators as driving along the freeway, and you're watching for the person in front of you to tap the brakes. You're not looking for stop signs or stop lights on the freeway. You're just looking for the guy in front of you to tap their brakes, and that's when you make a change to your own. So you're watching and observing what's happening. Momentum changed. The guy in front of you stopped speeding up or tapped his brakes. Suddenly something's different. We don't know that they're about to come to a dead stop. In fact, that's not the expectation, but something changed. Strong positive momentum, then it wanes. That's what we're seeing here. So, Albert, I've been going on and on, both on my soapbox as well as talking about some of these indicators. Anything you'd highlight or clarify in the points I've made?
I think that, well, first of all, you made a lot of good points. And I really like the way you started everything off by saying volume in itself is the indicator we use to determine if this might be something that we're going to get a fair price in. Because, one of the things that I learned as a floor trader and a market maker is if you don't have the volume to support what it is that you're trying to do, you have to really start to factor in a lot of slippage, right? In other words, the amount that you're going to lose based on execution. And so therefore, if you've got a wide bid ask, you don't have a lot of volume, you're going to have a lot of slippage, and it could be very frustrating, and it may really determine if whether or not your trading plan is a winner or a loser. So I do agree with you on that particular point. Volume is extremely important, especially just as a very beginning indicator of whether or not it's something you should be playing with. That being said, of course, there are a variety of different ways we can look at volume, and I really liked your approach, Jake, by kind of starting simple and moving on from there. So I'm going to do the same thing as well when I take a look at something here. And this is going to be, again, rather simplistic view of a volume indicator. And this is the volume oscillator. And simply put, this is just the ratio of two moving averages of volume. So again, what we're going to do is we're going to take a look at some moving averages. In this case, typically, I believe it defaults to a 5-period and a 10-period. We'll take the moving averages of volume at that point, and we'll compare how they're moving with each other. So in other words, if you've had a lot of experience using simple moving averages on price, this isn't really too much different. And this is really just kind of looking at volume, but from the same type of lens, looking at those different types of moving averages. So as you can see, this is working on the idea that not the actual level of volume, but the change in volume relative to the recent past. And that's exactly what we're trying to do. Has something changed in the last 5 days versus the last 10 days? Or are we seeing more volume? Are we seeing less volume, right? What has changed in that situation? So what we're going to do is we're going to use that to determine when volume is expanding or contracting. And if you think about it, if volume is expanding, that typically implies strength to the current trend. Not saying that it's up or down, but the current trend if we're getting more volume. On the flip side, contracting volume usually implies weakness, right? If we're getting, as Jake showed us earlier in NVIDIA, we get that move up and maybe volume starting to slow down a little bit, that might show a bit of weakness. So this can be used as a confirmation indicator for a trend. We can also use this as an advanced warning for a breakout when we're sitting in a range or a consolidation formation, right? This oscillator will rise during small advances and maybe declines during small declines. That might suggest that the eventual breakout will be upward. So much like volume itself, I would say the volume oscillator should really be used to confirm a trend. And you can see on this example right here, price is rising in this particular security with increased volume. So our volume, this has actually been changed to 20 and 60, but nonetheless, we're still seeing that it is rising over the same amount of time as price is rising as well. So again, confirming that trend right there is what we're looking for. So if we take a look at an example, I'm going to stick with NVIDIA just because I like that one as well, Jake. I think there's a lot of opportunities for us to demonstrate things here, but I'm going to pull up volume oscillator. So as you can see, It comes defaulted to 5 and 10. Again, you can change this to whatever you want it to be. I'll leave it there for just now, just for a moment. And let's take a look at maybe a particular example of what this might be showing us. So I'm going to back this up a little bit just to make it a little bit easier to see. But let's take a look at the beginning part of March here when we had our earnings. And what we're seeing is this starts to move up off of those earnings. And as you can see, the volume oscillator is also providing that context, letting us know that it's increasing with the price. But then as you notice, this part right here, like this area right here, when we get into this situation where we're sort of in a bit of a sideways trend, right? And at that point, that's when the volume oscillator starts to drop off, right? In other words, the moving averages are starting to become closer together. We're not really seeing a lot of trend. And if we think about moving averages and how they typically work, if we're seeing moving averages on price that are very spread apart, right? Very large gap between them, that typically tells us there's a trend in place, and probably a pretty strong trend depending on the size of that gap. If we have moving averages that are relatively tight to each other and consolidate in a small area, that tells us there's really not a discernible trend, right? It tells us that there's sideways action. Maybe we're in a period of back and forth for a particular security. It's not much different with the volume oscillator. So a volume oscillator starts to drop as we get into these trending situations. Now, we could probably extend this out and say, yes, it's pretty much in a range for the most part, earnings to earnings. And then what do we see here after the earnings again? We start to see another acceleration, but then we see a drop off as we progress higher. So can we look at that and say maybe that might be a warning sign? We could, but keep in mind with any oscillator, these are the type of indicators that, they're I'm trying to figure the best way to say this. An oscillator is something that should be used as a trend confirmation, right? A tool for confirmation, not necessarily as a signal generation, is what I like to think of it as. So we'll use these in conjunction with other things, but I think an oscillator in general should be thought of as a tool for confirmation. And that's sometimes you'll see on this particular one, especially if we have shorter terms, it might get a little sloppy, but the idea is intact that if we do see a strong trend, we would look for that volume oscillator to kind of follow along and confirm that. Now, sticking with volume oscillators, I'm going to show another one as well. Give Jake a little bit of a break on his voice there. And I'm going to pull up the Chaikin Money Flow. Now, this is another oscillator. This actually uses the Chaikin AD calculation. So if you're not familiar with this was developed by Mark Chaikin. Now, hopefully I'm pronouncing his name right, Jake, because I don't want to offend him in case he just happens to be in the audience today. But he actually created the Accumulation Distribution Index, AD. I'm sure many of you have seen that before. And what it does is it uses the high, low, and close prices each day. And then what it'll do is it'll determine within the daily range of where the close occurs. So very simply, if the close occurs above the midpoint, that's accumulation. If it happens to occur below the midpoint, that's distribution. And so that are added to an index. It's very similar to the on-balance volume with regards to the accumulation distribution. So getting back to our guy here, CMF, what it does is it goes and takes the sum of the AD over the last 21 days, and then it divides the total volume over the last 21 days. And what that does is it produces an oscillator, as you can see down here, that rises above zero when upward trend begins and falls below zero when a trend turns downward. So let's take a look. We can actually go into the modifications here, and you can set your overbought levels and your oversold levels, not bounded, so this could go technically wherever. So let's just say for now we'll set it at 0.20, and we'll set our downside at negative 0.20. And now we can see, if I hit apply, we've got our blue lines here indicating where we are overbought. We've got our red lines indicating where we are maybe seeing that downward trend. So if we were to take a look, and I'll remove this for just a moment, but as you can see during this trend, actually, while I have this up, really kind of back and forth, nothing discernible here, right? Not staying in between our overbought and oversold levels, back and forth, mostly above, but also here. And then we finally start to see it start to peek its head out above this top line here, and that does correspond with the movement in our overall our overall security. And then once again, as we get to this peak, starts to break down a little bit. But again, nothing too severe through here, still staying within that range. And then we see it peaking out below here as we get towards the end. So a couple of things to keep in mind when we are looking at these types of things, and certainly with this one in particular. This only uses the high, the low, and the close. So what does that mean? Well, that means it's not going to account for any gaps. And as with any oscillator, when we're using moving averages, there can be a drop-off effect, right? In other words, dropping that value from 21 days ago can certainly influence the value with regards to that. So let me pull up another one here real quick. I'll pull up SPY because I know everybody is familiar with that. And I have an area here highlighted that I thought was interesting. And what we can see is a situation back in July. Actually, I'm going to back up. I'm not even going to bother with those right now. Let's focus on July because I think this is part of how we can use some of these indicators. If you take a look at July, right, at this point here, we start to see this movement higher from a little bit of a range, I suppose, right? But we get this movement higher. And then what are we seeing with regards to our indicator down here? Well, we're seeing that divergence. And I always think that when I'm looking at these type of indicators, this is one of the things I always like to look for is that divergence. And then what do we see here? We see this divergence as we build up to this peak. And then when we start to roll over the top here, we start to go negative on the CMF. So again, I don't know, Jake, what your thoughts are on these particular things, but when I look at these types of oscillators, I like to think of them as opportunities for us to confirm something else that we might be seeing. Now, that could be through moving averages, that could be through another indicator altogether, but certainly when I want to understand what's happening with volume, these types of oscillators can certainly be helpful when we're looking at that. Any thoughts on either one of these, Jake?
I think Mr. Trek will be very pleased with your pronunciation, first and foremost. But yeah, as we think through these, we're all trying to do the same things, right? We're just trying to use that volume as an extra measure as we think about what's happening to the trend, to the price. You'll notice that we're not looking at that volume indicator as gold, but rather we're thinking about it in conjunction with the rest of our technical analysis, which of course relies upon that volume existing in the first place. So all of this is following suit in that exact same way.
Let me give you one more quick one that I think is interesting. That's a little bit different, but I do think it's still got some value to us. And let me clear this out real quick. So I'm going to add in a new one, and this is the volume weighted moving average. Since we're on the topic of volume, we might as well talk about something that everybody likes to talk about, which is moving average, and how do we play with that and add volume to it. So when we talk about time-based moving averages, we're making the assumption that all trading days are equal. But that might not always be the case. Let's take, for example, a typical Monday or Tuesday before a Wednesday FOMC. It's probably a bit slower, probably lighter volume. Now we compare that to, say, Wednesday afternoon or the following Thursday, and we probably see a slightly different situation with regards to volume. So I think that when I'm thinking through this, important trading days are usually associated with heavier volume. Now, when I bring that up, I've got the volume weighted moving average. And this basically is calculated by taking the sum of the product of volume and price over a period of time, and then dividing it by the total volume for that period. So it takes into account both the price and volume over a given period of time. It calculates the average price weighted by the volume of trades. So the resulting value represents the average price paid by all market participants during that period. And that would, in theory, provide a more accurate representation of the true market value. So how could this be used? Well, it certainly can be used similar to other moving averages. We can compare the current price of our security to its volume-weighted moving average to determine if it's overvalued or oversold, right? Or undervalued, I should say. We can also use to determine the strength of a trend, much like we always do with the moving average, right? An upward sloping right here, right? VMA, that would be an indicator of potentially a strong trend, while a downward sloping VMA, which we don't necessarily have one right here, but let me back this out a little bit. I'm sure we could find one. A downward sloping, for example, right here, would be showing us that a more of a downtrend. Of course, the more of a slope, the stronger that would be. But again, the same as what we would do with a regular moving average. However, the issue here is that again, we're trying to use volume to help increase our understanding, or at least what we think we see happening with these particular situations. So it can also be used to help traders identify potential support and resistance levels, right? When a price of an asset approaches the VMA, it can act as a support and resistance level, just like a moving average. It can focus on important price movements, especially during periods of increased trading activity, and really use it to gauge the strength of potential entries and exits. Now, that being said, what are the limitations? Well, again, it's heavily reliant on recent data points, and therefore it may miss out on important signals related to the underlying trend of a stock or asset. And certainly can be prone to large fluctuation during periods of high volatility, which can make interpreting the information difficult. So let me take a quick another look here. I'm going to pull up one more thing that I think is interesting with regards to. We'll look at SPY, and give me one moment while I pull this up. All right. So I'm going to show you just kind of a quick walkthrough of how this actually works, because I do think it's important to understand what it is that we're looking at with regards to the calculation, as always. Okay, so here we have, and I'll go back to the chart for just a moment just to show you what we're looking at. I just picked a random area of time, and I believe I did June 3rd through June 14th. So all the way back over here, I'll bring it back to 1 year, June 3rd to the 14th. All right, so this period right in here. Let me go back to my calculation real quick. So what this is doing is saying, okay, this first step is we're just going to take the closing price and multiply that by the volume. So if we take a look at the chart here, we can see that the closing price on this particular day and the volume, and we'll multiply it by each other, and here's our number. Now we'll do that for 5 days, right? And now you can see where we start to get our numbers at. So by the 6th day, we have this, excuse me, by the 5th day, we've got all of our volumes. We sum of those volumes, and then we divide them by the total, the closing price times volume by the sum of volume. That gives us our 531.87. So as you can see, we're taking all of this information and we're using this number, and then we're coming up with this. So that's where the volume weighted moving average is coming for. Now, here's where you can start to see how this would affect the moving average, right? Because you can see the different levels of volume. 24 billion, right, is the number. Volume is 46 million, 47, 30. So a wide variance of volumes. But the idea here is to understand when we have higher volume days and what it might be doing to the actual security itself. So again, this is going to be something that we can use very similar to a moving average. In fact, if we want to, we can even go back to the chart itself. And let me just go ahead and add on a simple moving average, just so we can compare the two. And then you'll see, let me change the period as well. So I'm going to change this just to match the other one. So it's 60 periods. And you can see they're relatively similar, but we do definitely get some different signals when volume is at different levels. So this might be something that, and SPY might not be the best example because it's pretty active every single day. It's the most active stock out there, or actively traded security out there. But if we get other securities that maybe are a little more dependent on volume, or maybe have actually slow days, like if we can compare it to maybe potentially NVIDIA, maybe we'll see a bit more, right? But there's definitely a slight difference. And again, this is one of those things, right, Jake, when you're talking about moving averages, some people prefer simple moving average. Some people like an exponential. Some people might like this volume weighted moving average. It just really depends on what it is what fits your narrative or fits your outlook or your trading plan. And this is just another tool to use volume and kind of incorporate it into those moving averages as you look at these things.
Yeah, as I think through the overall idea, folks, what we're looking for is trying to understand, what does the market seem to care about? If you found that there was a large difference between these lines and the price tends to bounce at the volume weighted version, not the other, use the volume one. Great. If you find that there's limited difference, like we're seeing here on NVIDIA, and the price is respecting either of them or not respecting either of them, look what happened a month ago when these just kind of knifed right through those 60-day moving average. really not a significant area for the price, it seems, whether you're using the volume weighted version or not. At least at that point, the market did not appear to have their eyes set on those particular targets. Rather, they were looking at other things. And so we're looking to understand them. So I guess I'll go ahead and take over from here, walk us into the last few minutes of the session. I want to highlight a couple things. You brought up a good point right there at the end, where we're talking about SPY maybe not being the ideal security. Well, let's take a look at another security that you're probably pretty familiar with. This is the S&P 500, folks, SPX. And let me add back on here our volume bars at the bottom. And then let's back our chart out to 10 years ago. You notice something strange happens here. The data provider that we use for S&P 500 calculates volume differently starting right here. You would want to be aware of this if you're a volume-focused trader. Make sure that you are aware of any large discrepancy. All is well. These are both accurate. As you know, you can't actually trade SPX, so they're an accumulated value. But the calculation changed at this point, and so it's this oddity on the chart. If you're going to rely heavily on volume, you should have your volume visible to you so that you can see if there was some strange change like what we're seeing here. Watching what happens, and likely we will see an increased volume for that specific day. So we're going to notice any differences, what stands out here as a potential change in volume. Number 3, we're going to go ahead and take a look and think about volume as a potential measure for divergences. We saw several occasions where that was the case on these charts over the course of the last couple months, looking at the NVIDIA chart, looking at the S&P 500 chart. There's probably one on here as well. But as we think through the price changes, what we're looking for is if the price keeps going higher while the volume indicator of your choice stops going higher. That's a divergence, and that's a concern. Likewise, if it is going down, but the volume stops going down, that's a divergence. These are warning signs, not a stop sign telling you jump in with all of your inheritance. No, this is a time to think about instead how and when you will react if the situation does change as you are seeing some warning signs presently. And finally, I encourage you to make use of volume to find areas of potential support and resistance using the price volume distribution or other tools similar. Now, we've got just 1 minute left. I wanted to address a question that was asked, and one that we cover actually on a fairly frequent basis, but maybe not in as much detail as was needed. Michael, you asked, what's the difference between the VWAP, or volume weighted average price? Most people call that the VWAP. The VWAP and the VMA, the volume moving average, volume weighted moving average that Albert showed for us. The difference is actually that the VMA that Albert showed acts just like a regular moving average. The volume weighted average price, VWAP, does not. In fact, when I add it here, it warns me intraday only. This thing doesn't even work on our longer dated chart. If I come in instead and look at a 5-minute chart, well, now I have the line, but you'll notice it always jumps and restarts here each and every day. That's because this is an intraday indicator used to calculate the average price since the open of that given day. It does not work the same as other ones where it would carry forward the value from previous. No, it resets at the start of every single day. This was a commonly requested feature that was only added to ActiveTrader Pro a few years ago. Maybe you haven't used it yourself, and you're welcome to give it a shot. The cousin to this indicator is not found here in ActiveTrader Pro, but those of you who have attended Constantine's anchored volume weighted average price class, AVWAP, anchored volume weighted average price, have used it on Fidelity.com. On Fidelity.com, we have a separate version of charting software that includes the anchored volume weighted average price, which acts more like the VMA perhaps because it does work over longer time frames. But the difference is instead of being arbitrarily mandated to reset every day, it starts at a point that you set. So you would draw, for example, a vertical line and say, starting at this area right after earnings, what's happened on the average price since then? And it draws in the line over time. And you can use that to find areas of importance for the chart. Phenomenal work that Constantine does putting those together for you. Those of you who haven't seen that particular class, it's taught every other Wednesday. And so you're welcome to go ahead and drop in on that if you would like to join. It looks like the next time that happens is actually this coming Monday. That's taught at 1:30 Eastern time. If you want to jump in and take a look, it's called Anchored Volume Weighted Average Price, the Volume Profile, and Fibonacci's with Constantine. Essentially, it's some of Constantine's favorite indicators, and he'll walk you through some of his favorite charts as you take a look at it. So, folks, that's a great opportunity to go ahead and wrap things up there. All right, let's see. Nikhil was wondering if we could show one more time how to access those horizontal bars. They're right up here under settings. It's this show price volume distribution. Check or uncheck that box to your liking. It's also how I add in the regular volume chart if I've removed it from my screen. Hit apply and they're there for you. You can also add or remove it from right-clicking and hitting settings. I just find it's a little harder to hover my mouse in just the right spot here to do the same change. Any other questions that stand out to you here, Albert, or shall we wrap things up?
I think we've covered most everything. I think the important thing to remember is, Jake and I are not saying go out there and start using volume as an indicator. We just want to make sure that you understand the components of volume indicators, how to use them, the different availabilities of volume indicators. As you can see, there are quite a few, and we just touched on them. There's plenty more beyond that. But, take a look, see if it's something that might be useful to you. Maybe run two charts side by side, add something, and see if you can get some signals out of it. But hopefully you've got something out of this, and then hopefully it will add to your trading plan over the course of your career. Jake, always a pleasure to share the screen with you. Hope everyone has a great rest of their day, great rest of their week, and we'll see you next time.